What if I told you that most people who buy precious metals never actually build real wealth from them? They buy randomly, follow headlines, panic during price drops, and end up selling at the worst possible moment. Meanwhile, a small group of investors quietly follow a simple but powerful strategy that allows them to turn precious metals into a long-term wealth protection system. In a world where inflation keeps rising, global debt is exploding, and trust in paper currencies continues to weaken. Understanding how to build a precious metals investment plan from scratch might be one of the smartest financial decisions you can make. If you stay with me in this video, you'll learn exactly how experienced investors build their precious metals strategy, step by step. How much of your portfolio should actually be in metals, the biggest mistakes beginners make, and how to position yourself before the next economic shock sends demand for metals soaring. Before we dive in, if you're interested in protecting your wealth, understanding global financial shifts, and learning strategies used by serious investors, make sure you subscribe to the channel because we break down complex financial topics into simple, practical strategies anyone can use. Let's start with the first and most important step in building a precious metals investment plan, and that is understanding why you're buying metals in the first place. Many beginners buy precious metals because they hear that prices are going up, or because someone on the internet says silver is about to explode. But serious investors think very differently. They don't buy metals to get rich overnight. They buy them to protect purchasing power and hedge against systemic financial risks. For thousands of years, civilizations have trusted precious metals as a store of value. Long before modern currencies existed, people were already using metals like gold and silver as money. Even today, central banks around the world still hold massive reserves of gold. Institutions like the Federal Reserve and other global central banks closely watch the price of gold because it reflects confidence in the global financial system. The second step is deciding how much of your portfolio should be allocated to precious metals. This is where many investors make their first mistake. Some people go all in, putting half their wealth into metals because they believe a financial collapse is coming. Others ignore metals completely because they think stocks will always outperform them. The truth lies somewhere in the middle. Most financial professionals recommend allocating somewhere between 5 and 20% of your total investment portfolio to precious metals. This allocation provides protection without sacrificing growth opportunities from other assets like stocks or real estate. A typical allocation strategy might look something like this. Around 60% of your metals allocation goes into gold, which tends to be more stable and widely recognized globally. Around 30% goes into silver, which is more volatile but has significant upside potential because of its industrial demand. The remaining portion can be placed into metals like platinum or palladium, which are heavily used in industrial applications such as catalytic converters and emerging technologies. Once you understand how much to invest, the next step is choosing the form of metal you want to own. There are 3 primary ways investors gain exposure to precious metals. The first and most traditional method is physical ownership. This means buying coins or bullion bars that you physically possess or store in a secure vault. Popular coins include the American Gold Eagle and the American Silver Eagle. Physical metals offer the advantage of true ownership. There is no counterparty risk, no dependence on financial institutions, and no exposure to digital trading platforms that could freeze during extreme market events. However, physical metals also come with responsibilities. Storage, security, insurance, and liquidity all become factors you must consider. This leads many modern investors to explore the second option, exchange-traded funds. ETFs allow investors to gain exposure to metals without physically storing them. One of the most widely traded gold ETFs is SPDR Gold Shares. These funds track the price of metals and trade just like regular stocks, making them extremely convenient for investors who want quick access and liquidity. The third method involves investing in mining companies. When you buy shares of a mining company, you're investing in a business that extracts precious metals from the ground. Companies like Barrick Gold and Newmont Corporation can sometimes outperform the metals themselves because their profits increase when metal prices rise. However, mining stocks also carry additional risks related to management decisions, operational costs, and geopolitical issues in mining regions. Now, here's where the real strategy begins. Instead of buying all your metals at once, smart investors use a technique called dollar cost averaging. This means investing a fixed amount of money at regular intervals regardless of price fluctuations. For example, instead of investing $10,000 into metals on a single day, you might invest $500 every month. Over time, this strategy smooths out price volatility and reduces the risk of buying at market peaks. Another critical part of a precious metals plan that many people overlook is storage strategy. If you choose physical metals, you must think carefully about where those assets will be stored. Some investors keep a portion of their metals in a home safe for immediate access, while storing the majority in secure vault facilities or bank deposit boxes. Diversifying storage locations can provide an additional layer of security in uncertain times. Beyond storage, a complete investment plan also includes an exit strategy. Surprisingly, many precious metals investors never think about when they will sell. They simply keep accumulating metals indefinitely without any clear objective. Smart investors define specific conditions that trigger selling decisions. For example, if metals grow to represent more than 25% of your portfolio, you may rebalance by selling a portion and reinvesting into other assets. Alternatively, if economic uncertainty drives metals to extreme highs, selling a portion during peak demand can lock in significant profits. Another factor that influences precious metals markets is global monetary policy. Decisions made by institutions like the Federal Reserve regarding interest rates and money supply can have a powerful effect on metal prices. When interest rates are low and currency supply expands rapidly, investors often turn toward precious metals as a hedge against currency depreciation. Industrial demand also plays a major role, especially for silver. Unlike gold, which is primarily used for jewelry and investment, silver is heavily used in electronics, solar panels, medical equipment, and advanced manufacturing technologies. This dual role as both a precious and industrial metal gives silver a unique position in the global economy. If technological demand accelerates in the coming decades, silver could experience significant price volatility as supply struggles to keep up with industrial consumption. Finally, perhaps the most important principle of building a precious metals investment plan is patience. Precious metals are not designed to deliver overnight riches. Instead, they function as a long-term insurance policy for your financial future. During periods when markets are stable and stock prices are rising, metals may seem boring or underperforming. But during times of economic crisis, geopolitical tension, or currency instability, metals often become one of the few assets investors rush toward. History has repeatedly shown that when trust in financial systems declines, demand for precious metals surges rapidly. Investors who built their strategy early often find themselves in a strong position when those moments arrive. So if you're starting from scratch, the key steps are simple. Define your purpose, determine your allocation, choose the right form of metal ownership, invest consistently using dollar cost averaging, secure your storage, and establish a clear exit strategy. By following these steps, you transform precious metals from a random purchase into a disciplined financial plan designed to protect and grow your wealth over time. The biggest mistake investors make is waiting until a financial crisis begins before thinking about precious metals. By the time panic buying starts, prices have often already moved dramatically. The smartest investors prepare long before the headlines appear, and that raises an important question. If the global financial system faces another major shock tomorrow, would your portfolio be protected, or would you be scrambling to react like everyone else? Because in the world of investing, preparation is often the difference between those who panic and those who profit.